Equity Bank shares, ticker EQBK. Q2 2026 earnings just hit the wire. Here are the absolute headline numbers for you.
Let's hear them.
GAAP EPS came in at $1.27 EVK share, but the core EPS, which strips out all that one-time accounting noise, that sits at a massive 30 of 41 cents.
Wow. Okay.
Right, and revenues, specifically net interest income, hit $73.8 million. I mean, that is a 48.3% jump year over year.
That is just huge.
It really is. And looking ahead to the second half of 2026, management is guiding for a net interest margin between 4.25% and 4.35%. Non-interest expense is tightly bracketed between $94 and $98 million.
You know, the context around that $1.41 core EPS, that's what really changes the narrative from anyone holding this stock right now.
Oh, for sure. Because if you look back just one quarter, right?
Exactly. Q1 EPS was sitting at a very sluggish 80 cents. So we're looking at this sequential leap in profitability that it demands an immediate explanation. I mean, banks of this size, they just don't normally double their earnings power in 90 days, without some underlying structural shift.
Yeah, imagine eating a meal so heavy it takes you 3 whole months to fully digest it. That was Equity Bank shares in Q1.
Ah, swallowing Frontier?
Right, swallowing a rival bank called Frontier. But today, this Q2 print shows a bank that isn't just digested, it's literally sprinting.
Yeah, they're completely off to the races.
So today we're doing a deep dive into these Q2 earnings reports and the management commentary. We need to find out exactly how EQBK engineered this massive sequential leap.
And what the underlying mechanics of their balance sheet are actually signaling to you, the investor.
Exactly. And most importantly, what this operational cleanup means for your portfolio moving into the back half of the year. Let's unpack the margin expansion first.
Yeah.
Because that net interest margin, or NI, is just the lifeblood of a commercial bank.
It's everything. The spread between what they earn on loans and what they pay out on deposits.
Right. So in Q1, their margin was 4.33%. In Q2, it actually ticked up to 4.36%.
3 basis points of expansion, which, to a casual observer, a basis point is just 1/100th of a percentage point. It sounds like a rounding error.
Right. It sounds totally negligible.
Oh, but it is definitely not. When you apply 3 basis points across a $7.7 billion asset base, you are talking about a significant river of absolute cash flowing directly to the bottom line.
And the mechanics of how they squeezed out those extra 3 basis points. It's honestly a masterclass in balance sheet management during a really, really weird macroeconomic moment.
Very weird moment. Break down those mechanics, because it wasn't just like a single lucky break on one large loan.
No, it was a two-pronged attack. So the yield on their interest-earning assets rose by 1 basis point, which is solid. But the real shocker here is that the cost of their interest-bearing liabilities, so the money they pay out on deposits and borrowings, that actually dropped by 5 basis points.
Which is kind of wild if you think about it.
It's totally counterintuitive. Like, you look at the broader economy with elevated inflation, monetary policy keeping rates high, depositors are actively hunting for yield everywhere.
Oh, yeah. Every bank is fighting tooth and nail right now to keep deposits from fleeing to higher-yielding money market funds.
Right, so managing to drop the cost of your liabilities sequentially, it just feels almost impossible. They must be aggressively shedding expensive short-term wholesale funding. Right?
And replacing it with cheaper, sticky core deposits. Yeah, that mix shift is a major piece of the puzzle here.
Because banks usually rely on that hot money right after an acquisition.
Exactly. They often use expensive broker deposits, or they borrow from the Federal Home Loan Bank to plug short-term liquidity holes, especially right after closing a deal like the Frontier one.
And those funds are incredibly costly.
Very. So what you're seeing in Q2 is the natural optimization of their funding stack. They just let the expensive hot money roll off the balance sheet,
relying instead on their regional branch network.
Yep, to generate lower-cost core deposits from everyday businesses and consumers. And on the asset side, they aren't just sitting on their hands either.
Right. They saw a definitive shift out of lower-yielding cash reserves and deployed that capital into higher-yielding investments and new loan originations.
Which brings up another really interesting line item. There's a $2.9 million entry in this quarter's net interest income tied to something called loan purchase accounting accretion.
Ah, yes. Whenever a bank is highly acquisitive like EQBK, this term always pops up.
It does, every time.
So my understanding, and correct me if I'm wrong, is that when they bought Frontier back on January 1st, they inherited their entire loan portfolio. But they don't just, copy and paste the face value of those loans onto their own balance sheet, right?
No, they definitely don't. They have to mark them to a fair value.
Right, which usually means applying a discount to account for potential credit risk or just the fact that those older loans carry lower interest rates than current market conditions.
You've got the exact mechanism down. So let's walk through how that actually hits the income statement for you as an investor, because it contributed about 17 basis points to their margin this quarter.
That's a huge chunk.
It is. Say you acquire a commercial loan that has a face value of $1 million. But because it was underwritten a few years ago at a lower rate, you mark its fair value at, say, $950,000 on day one of the merger.
Okay, so there's a $50,000 difference.
Exactly. As that borrower makes their regular monthly payments, and as that loan eventually pays off or matures, that $50K discount isn't just lost into the ether. It's accreted or steadily added back into the bank's interest income over the life of the loan.
Oh, so it's a non-cash mechanical boost to the top line.
Bingo. Management fully expects it, but as an investor, you have to mentally separate that accretion from the core organically generated interest income just to understand the bank's true run rate.
Well, that actually brings me to a serious point of pushback on management's forward-looking narrative.
Jose, let's hear it.
We just established that the asset shift is working, right? The funding mix is optimized. The NIM just expanded to 4.36%.
Right.
Yet, when management provided their guidance for the second half of 2026, they told the market to expect a lower margin, specifically between 4.25% and 4.35%.
Yep, they did.
So, if everything is humming so perfectly, why are they guiding down? Like, is management just sandbagging so they can easily beat expectations in Q3? Or is there some structural headwind hiding in the balance sheet?
So this is a phenomenal trap that trips up even seasoned retail investors when they read bank earnings.
Really?
Yeah. It comes down to the denominator effect of earning asset expansion. Management explicitly noted that they anticipate broader earning asset expansion in the second half of the year. They want to aggressively grow their total loan and investment balances.
Okay, so they're basically planning to bake a much larger pie.
Exactly. And that larger pie changes the percentage math. If you aggressively grow your total loan book, you're generating more absolute dollars of net interest income.
You're taking more cash to the bank, literally.
Yeah, literally. However, those new loans might be coming onto the books at slightly tighter spreads than your highly seasoned legacy portfolio. Or, quite simply, your denominator, the total asset base, is growing so fast that the overall margin percentage slightly dilutes.
Okay, wait, let's dwell on this for a second because it's a critical concept for anyone analyzing a bank stock. You're saying we shouldn't view a 4.25% forward margin as a failure or like a sign of weakness.
Far from it. I mean, it's a trade-off that any rational executive team would make.
How so?
Well, think about it. Would you rather have a 4.36% margin on a $5 billion loan book or a 4.25% margin on a $6 billion loan book?
Oh, I see. The latter produces significantly more actual profit.
Exactly. The absolute dollars feed the shareholders and fund the dividends, not the percentage ratio. Plus, as we just discussed, they're modeling for that purchase accounting accretion from the Frontier deal to slowly taper off.
Right, as those acquired loans naturally mature.
Yes. The mechanical boost will fade, but the absolute organic growth will more than replace it.
So the margin percentage takes a tiny haircut, but the raw net interest dollars grow. That makes total sense, but, margin is only half the profitability equation. Earning money on loans is great, but if your back office is a bloated mess, that margin gets eaten alive before it ever reaches the bottom line.
Oh, absolutely. The back office efficiency is make or break.
So I want to look at the Frontier effect, how this recent M&A activity is finally paying off in the expense column.
The expense control in this Q2 print is honestly, it's arguably the most bullish signal for the long-term health of the franchise.
Really? The most bullish?
Yeah. Because think about the reality of acquiring another financial institution. On day one, you essentially have two of everything, two separate IT networks, two executive compensation packages.
Duplicate branches sitting directly across the street from each other.
Exactly. The entire financial logic of bank M&A is the ability to aggressively consolidate those overlapping costs. You have to achieve operating synergy.
And CEO Brad Elliott, he made it crystal clear in his commentary that the heavy lifting is completely in the rearview mirror now. The Frontier transaction closed on January 1st.
Which is a huge relief.
And by the end of Q2, the core system conversion was completely finished. And that's usually the most painful, high-risk part of any bank merger, right? When you're porting over thousands of customer accounts.
It's terrifying. Things can go wrong so easily. But they did it. And the numbers validate his claim perfectly. I mean, total non-interest expense plummeted to $46.9 million this quarter.
Wow, down from $55 million in Q1.
That is an $8.1 million quarter-over-quarter reduction in operating expenses.
That's massive.
It is. In the banking business, cost takeout of that magnitude drops straight to the bottom line. It doesn't get taxed by inefficiencies.
It perfectly validates that heavy meal analogy we used earlier.
Yeah, Q1 was definitely the indigestion phase.
But you're talking about severance payouts, early termination fees for redundant software contracts, just the general friction of trying to run two distinct banks simultaneously.
It artificially depressed their earnings.
But Q2 represents the clean metabolic energy of a fully combined, highly efficient single bank. The meal is digested, and the machine is just printing cash.
And the resulting metrics from that clean energy are striking. Because of that $8.1 million cost takeout, their efficiency ratio dropped to 53.4%.
Okay, so for the listener, the efficiency ratio is like the golden metric for bank operations. It measures how much it costs the bank to generate a single dollar of revenue.
Right.
So EQBK is currently spending 53.4 cents to make a dollar.
To contextualize how strong that is, a 53.4% efficiency ratio places them in the upper echelon of operating performance for regional banks.
Really? What's the benchmark?
Anything under 60% is generally considered very well run. Furthermore, that represents a 10.2 percentage point improvement year over year.
That is just phenomenal. And when you combine that incredibly tight expense control with the absolute dollar growth in the margin we just discussed,
you get their core return on average, tangible common equity, or OATCE, hitting 17.2%.
a 17.2% OATC. That's the kind of underlying profitability metric that makes institutional investors build massive positions.
It really is.
But speaking of the indigestion in Q1 versus the clean Q2, I was digging through the income statement and noticed a massive swing in their effective tax rate.
Ah, yes, the tax rate anomaly.
Yeah. In Q1, the effective tax rate was painfully elevated at 23.7%. But in Q2, it dropped to a much more normalized 21.6%.
Yeah, quite a drop.
My gut tells me this wasn't just like a sudden change in federal tax law, but rather another symptom of the messy merger mechanics.
Your instinct is spot on. The elevated Q1 rate was a purely accounting-driven event. It has to do with something called state apportionment.
State apportionment. Okay, walk me through that.
Well, when EQBK bought Frontier, the geographic footprint of their business physically changed. They suddenly had a different percentage of their total operations located in different states.
And different states have different corporate tax rates.
Exactly. So the bank had to legally remeasure the value of their deferred tax assets based on this new blended geographic footprint.
Oh, I see. So because the map of their business shifted, the future value of their tax deductions shifted.
Yep. Forcing them to take a one-time paper loss on the chin in Q1.
Man. So it artificially suppressed their net income in the first quarter.
That is the exact mechanism. The 21.6% rate we see now in Q2 is much closer to their true, ongoing operational run rate. It's just the final piece of evidence proving that Q1 was just the messy, unavoidable integration quarter.
Okay, so the operations are lean, the tax noise is gone, and they are printing cash from their margins.
A solid setup.
But all of that operational leverage vanishes overnight if the loans they're making go bad.
Very true.
Which brings us to the ultimate stress test in today's economy credit quality. I mean, you can have a 53% efficiency ratio, but if your commercial real estate portfolio starts defaulting, you're in deep trouble.
Credit quality is always the absolute priority when reading a bank earnings report. But you're right, it demands hypervigilance right now. The macro pressures are immense.
Seriously. We're seeing cracks in multifamily housing projects elsewhere in the sector. Consumer health is being tested by inflation.
So let's look at how EQBK is actually weathering that storm. Their provision for credit losses fell sharply to $1.3 million in Q2.
Which is down significantly from Q1.
Right. But the metric I care most about is net charge-offs.
The actual loans they had to write off is completely uncollectible.
Exactly. That number was highly manageable at $1.7 million. On an annualized basis, that is just 12 basis points of their average loans.
Wow. Sustaining just 12 basis points of net charge-offs in a high-rate environment, that is pristine credit performance.
It really proves that their historical underwriting standards, like who they choose to lend money to and the collateral they demand, are holding up incredibly well.
And for the loans still on the books, their allowance for credit losses, or ACL, sits at 1.19% of outstanding balances.
Just to clarify, the ACL is essentially the rainy day fund they set aside for future defaults.
Correct. And if you add in the purchase discounts on the loans they acquired from Frontier, those fair value marks we talked about earlier.
Oh, right. The effective reserve jumps to 1.73%.
Exactly. They are extremely well provisioned for any potential macroeconomic bumps in the road.
However, they did note a slight uptick in non-performing assets.
Uh-huh.
Yeah, up to $66.3 million, which is about 0.86% of total assets.
What's driving that?
Management primarily attributed that to specific loans inherited from the Frontier portfolio. It's definitely something to monitor, but well within manageable thresholds given their reserve levels.
Okay, fair enough. Now, I do want to flag a headline number in this report that might, trip up algorithm-made trading bots or investors who only skim the press release.
The fee income miss.
Yes.
Yeah.
Total non-interest income, which includes all the fees the bank generates outside of lending, that dropped to $8.1 million, down from $9.5 million in the prior quarter.
And on the surface, a $1.4 million drop in fee income looks like the core business is losing momentum.
This is exactly why you cannot rely on automated summaries. You have to read the footnotes.
Always read the footnotes.
That headline miss was entirely driven by a $2.2 million one-time write-down on a specific fund investment.
So it's a non-operating, non-recurring hit to the income statement.
Right.
Yeah.
So if we strip out that one-time loss and look at the actual banking operations, what did the core fee business do?
Adjusted for that write-down, core fee income was actually $10.3 million. That's an increase of $700,000 sequentially.
Oh, so it went up.
It did. They saw real organic expansion in debit and credit card income and steady growth in their mortgage, trust, and wealth management divisions. The core fee engine is actually accelerating.
Okay, but speaking of acceleration, here is where I see a glaring contradiction in the balance sheet.
Uh-oh, play it on me.
I need you to unpack this macro dynamic.
Go.
So management, specifically CEO Brad Elliott, is preaching that with the integration over, the second half of 2026 is entirely about, and I quote, execution and organic growth. But if you look at the total loans held for investment at the end of Q2, the balance actually shrank. It dropped by $22.6 million to end the quarter at $5.4 billion.
Yep, it shrank.
So how can management claim they are a growth engine if the loan book is literally contracting?
It is the ultimate banking dilemma in a high-rate environment, and it's a phenomenon playing out across the entire regional banking sector right now.
Really? It's not just them?
Not at all. To understand that slight contraction, you have to look at the push and pull of borrower behavior when the cost of capital is elevated. When interest rates are sitting at 7 or 8%, corporate borrowers are highly incentivized to use any excess cash flow to pay down their existing lines of credit as fast as possible.
Well, yeah, because holding debt is painfully expensive right now.
Exactly. Simultaneously, the pipeline for new commercial loan originations naturally slows down. Businesses are delaying expansion projects due to those exact same high borrowing costs.
So a shrinking loan book isn't necessarily a sign that the bank's sales team is failing to find new clients.
No, it's often a dynamic where the pace of existing loans paying off early is temporarily outstripping the pace of new loans coming onto the books.
Ah, so they were simply treading water while they digested the Frontier acquisition. They weren't trying to force aggressive, risky loan growth while their back-office teams were busy converting core IT systems.
Right, or finding those $8 million in expense savings.
That is the exact strategic read.
Q2 was entirely about stabilizing the balance sheet post-integration. But going forward, CEO Brad Elliott explicitly called out Rick Sems, the CEO of EQBK. He noted that Rick has positioned the origination teams to drive organic growth.
Because the infrastructure is now flawless.
Exactly. So the second half of 2026 is the ultimate test. Can Sems and the team generate high-quality loan growth amidst elevated inflation and macroeconomic headwinds? Q3 and Q4 will show us if they can actually execute on the volume side.
Which brings us to the ultimate conclusion. What this operational cleanup actually means for you, the investor holding EQBK stock right now.
Let's look at the capital return metrics, because when you buy a bank stock, you're buying a slice of their equity, and you want to see that equity compounding.
Exactly. Book value per share rose to $40.22. More importantly, tangible book value hit $33.45.
And tangible book value is the absolute gold standard metric for bank valuation. It strips out all the intangible goodwill created by past acquisitions and tells you the raw, hard asset value of the company.
Growing that number sequentially is the hallmark of a healthy bank. They also announced an 18-cent dividend. But, what really catches my eye is that they are actively buying back their own stock.
Yep, buybacks.
During the quarter, they repurchased over 211,000 shares at a weighted average cost of $45.02, And they still have roughly 116,000 shares authorized for repurchase in the chamber.
When a bank management team aggressively buys back stock at those levels, it sends a very clear signal to the market.
Which is?
They believe the public markets are undervaluing their true tangible book value and their future earning power. They are putting their money where their mouth is.
And they can afford to do this because their capital position is rock solid. Their Common Equity Tier 1, or CET1 ratio, which, for the listener, you can think of as the bank's ultimate financial shock absorber against catastrophic losses, that stands at 11.84%.
Which is well above regulatory minimums. They have excess capital just piling up on the balance sheet.
Which leaves us with one final, very provocative strategic question to ponder as we watch this stock in the back half of the year.
Let's hear it.
Let's zoom out and look at the historical timeline for a second. Equity Bancshares has executed 15 total acquisitions since 2010.
Wow. So they were a serial acquirer.
Exactly. Buying other banks and extracting operating synergies is baked deeply into their corporate DNA.
It's their primary proven mechanism for scaling total assets and driving long-term shareholder value.
Right. So consider the scenario we just outlined today. The Frontier integration is flawlessly in the rearview mirror. Expenses have been violently rationalized down to a 53.4% efficiency ratio. The core systems are unified, and capital is stockpiling on the balance sheet, evidenced by that massive 11.84% CET1 ratio.
Right.
Management is publicly telling the market that the next phase is to just grow organically. But with 15 acquisitions in their history, are they actually content to just sit on their hands, originate local loans, and slowly buy back stock?
Or are they quietly reloading the M&A cannon right now?
Exactly. Hunting for the next undervalued community bank to plug into this highly efficient machine in 2027.
It's a great question. You have to keep an eye on how they deploy that excess capital over the next 2 quarters.
Absolutely. Well, if you want daily, no-fluff coverage that actually uncovers the mechanics behind the earnings prints, hit that follow button.